The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, as investors take a look at all the things that are going on in the global economy, if they look at their financial advisor for guidance on portfolio structure, or they go to a website, what they generally end up with is a cookie cutter model. And if you've been with us before, it's been a while, but we're going to go back and address some of the issues with regard to using this, which is referred to in the financial marketplace as modern portfolio theory. Modern means it was developed in 1952. So that's the same time period that Studebaker was struggling to stay in business. It managed to go into bankruptcy. Unfortunately, modern portfolio theory didn't make bankruptcy. So how do you get here? Generally, we are told to be diversified. That solves your problem because the markets always go up, and roughly about 75% of the time, the U.S. market does go up, but the other 25% is our problem. So how do we position our portfolio? Most of us end up with the starting point of answering questions. How old are you? How much money do you have? How much you need to take out of your account? What are your goals? Are you healthy? When are you going to retire? How much risk do you want to take? Well, on the assumption that your opinion of risk is a determinant in how the market works, which if you've been with us before, you know that's not true. Nobody really moves the market based on your risk assumptions. So the advisor or the website, based on your answers, pegs a model. And in this particular model, it's a global model that says most of your money should be in the United States and the rest of it overseas. So typically, these models will also include an allocation to bonds and maybe a very small amount into commodities, basically gold and silver. This is a Paul, name slips my mind, the set it and forget it model. And basically, it's never adjusted unless you change the answers to your questions. So let's just take a look at this for a moment. So here's the S&P 500. I've gone back about 3.5 years. Here's the S&P 500 over that period of time, and we've had, during 22, we had a sell-off down here. This is Germany's fund, and as Perry said, Germany made a critical decision during COVID to basically force people to stay in their jobs instead of letting them go out and express entrepreneurial activity. That's pretty typical of the German mindset historically, and more or so, I would say, of Europe in general. But the U.S. is in early stages of a bull market. This period here where we bottomed in 22 and has gone up has raised some questions of how high is high? How far can this keep going? Our argument, as I hope to reinforce as we finish up here today, is that we don't know how high is yet, but we certainly have, as Perry explained, developing economic strength with the entrepreneurial allowance in our economic and cultural system. But Europe's just isn't keeping up, either with the markets or in their economy, and they haven't for a long time. Investors following mainstream advice by investing in international stocks have been clobbered. Germany is only up it is actually negative return if we go from this starting point back here to this starting point. That's a negative return of almost 8% over the last 3.5 years. I've had phone calls saying, I don't know what you guys do, but I know I'm not happy with mine. I see the market going up, and my advisor has me diversified through such stuff, and I just don't feel like I'm making any progress. Well, if you have exposure to international stocks, you have an anchor on your boat slowing you down, or maybe you still have your your line's tied to the dock and you just haven't gone anywhere. That's what it kind of feels like. But if you're in assets that have lost 8% over the last 3.5 years, yeah, you're frustrated. But Germany isn't the only problem. Don't want to pick on them. So here is Europe. This is the equivalent of our S&P 500. It's the European 350, and it's done better than Germany because it's only minus 1% over the last 3.5 years. But this is Europe. What about a broader exposure to international? This is EFA, which is Europe, Asia, and the Far East. And these are large countries, not emerging markets. So I don't want to pick on them, but basically you're still flat or slightly negative. So forcing an allocation into international stocks has been a mistake for several years, degrading, reducing your portfolio return and the benefit of you exposing your capital to market risk. But that's the way the general financial advisory system is set up, is you express your opinion in response to questions. They assign a number to your answers and they peg you into a portfolio. And I've looked at Germany and Europe here in the broader market. The other country that's in Asia is Japan, and Japan has struggled. I mean, they've started to do better here the last couple of years, but when we take a look at the starting point, they're just barely higher than where we were 3.5 years ago. So even though you have one of the largest consumer economies in the world in Japan, it still hasn't been a strong addition to your portfolio. Now this is China. China, that's what this black line is. China, similar to Germany, forced people to stay home, and they maintained their pandemic closures for 3 years before let people out. And they are now doing some monetary manipulation to try and restart the economy. And these are big bets that were made on the speculation that it would work. And here's some pullback on the basis that maybe those bets aren't going to work after all. Now, perhaps you're in a 401k account, or you've seen some of the marketing on financial websites that you take the position, I don't really know how to do this stuff. This seems too complex for me, and I'm not going to retire until 2050. I'm just going to pick a fund that manages it for me. And that's what target date funds are. And if you're in a 401k plan, you undoubtedly have a target date fund. I just picked one. I mean, these target date funds that are currently active, there's actually some that should have been closed down and converted into retirement funds that go back to 2005. But currently, the current age span is 25, assuming you retire in 25, to 2065. The premise is you pick one of these funds and they will manage the process actively. That's the assumption on where you should be invested over time given your retirement date. So if you're going to retire in 50, this current fund is invested 41% in international securities. Those are the ones I just showed you. China, Japan, Europe, Germany. We didn't get into emerging market funds, but emerging market countries are the ones that are not yet developed and have substantially high risk. Non-US equities may include in these funds some emerging market. And you wonder, how can this be? If Wall Street's so smart, why aren't they putting money where it's working? In addition, they have 11% in bonds. This negative number would imply that you're using some margin, or they have some other assets that are private investments that cannot be readily evaluated. The problem here is a twofold. This is pretty much a static allocation. When you get another 5 years downstream, the allocation will be adjusted to put more money in bonds. You get another 5 years downstream, and they're going to put more money in bonds. In this particular fund, the management expense is 75 basis points, or 0.75%, which is really high expense ratio for sitting on their hands. This is not actively managed, or you wouldn't have 41% outside the US in the current marketplace. So here's what happens with the bond allocation. So there's the S&P again. That's the same chart I just used on the others. And then this black line is investing in bonds over the last 3.5 years. And your bond allocation has a negative return over that time frame of negative 13.6%. That's an anchor on your returns. But the typical 401k plan and the typical financial advisor says the older you get, the more bonds you have. Well, bonds until Friday had been in a 4-year bear market. This year, the bond market, the broad bond index, the AGG, which is Barclays broad bond index, finally moved above zero. It's a fraction of 1%, but at least for the year to date, it's no longer negative. Now, that happened a month ago. It was on the verge of being positive, and then it went negative again. We still don't know what's going to happen the rest of the year. If inflation numbers start ticking up, this number is going to turn negative again. It's still going to be negative 13% for the last 3.5 years. So your asset allocation model, the older you get, says the more bonds you should own. But you have to ask, why am I supposed to own more of what is not working just because I'm older? We don't think that makes any sense. So we do not use that kind of model. Our model is based on what's working. We want to own the stuff that's going up. It's never a straight line, and that's evidence right here. This has a lot of wiggles in it, but the trend remains positive. One of the other trends that happens to be positive of late happens to be precious metals. Folks usually buy assets, and particularly gold, as prices rise. But what we haven't seen yet in the stock market is we haven't seen a rush of retail investors. Retail investors, there were a lot of new investors who speculated as the market rallied out of the COVID. And as I spoke with a young man, well, young, late 30s, I think, as he said, a lot of his friends went into the stock market then and they lost all their money. I said, well, they weren't investing, they were speculating. And of course, if you speculate, that's just like going to Vegas, the odds are not in your favor. Gold has been rising of late. People get excited when prices are rising up, and it does cause investors to jump into something often without a lot of experience, knowledge, or research. And they're jumping in at the worst possible time. And actually, on the gold market, while it's been rising lately, that's not what's happening. Gold has hit several new all-time highs, but investors are still ignoring it. They simply aren't buying the way they did in the last rush to a new high, which is back in 2010 and 11. They're showing no interest at all in, despite the highs in gold. Well, they've got highs in the stock market, and they've got new highs in Bitcoin and other cryptocurrencies, which are keeping them distracted. The Chicago Metals Exchange is an active place for investors with little money to trade futures or options. And wanting to increase that business, the CME is introducing a new contract in January to trade a 1-ounce gold contract, which lowers the amount of money that an investor needs to get started with. That's really to suck in investors who know nothing about what they're doing and find another way to make a lot of money on the exchange. not for the investors, but for the exchange. So when we look at gold and the major move we've had in gold, why has gold risen as much as it has if domestic investors are ignoring it? And it's basically because it's been driven by Chinese. They're buying jewelry and bullion, and they're doing so because they are fearful that the government will do again what it did during COVID, and the banks don't work, and they shut down the real estate market. They've lost their investments in real estate. They were locked in their apartments for months on end, basically a couple of years, with inability to get out. And there's a massive move to resign from the Communist Chinese Party. This is a silent objection, silent revolt, if you will, in China. And what's their safety factor financially? It's gold. And they're the ones who have been pushing prices higher. Dana Samuelson's the founder of the American Gold Exchange, and he pointed out that the peak of gold was in 2011, and it was a retail frenzy at that point in time. That is right here. This is 2011, and here's this peak. Now, Perry and I were on the radio at the time, and when this was occurring, based on our looking at our technical charts, we said on the air, if you're in gold, now's the time to take your profit. You should do so. And the same applied at the time for emerging markets. Rich Checken, who is president of Asset Strategies International, is also a major proponent of gold, and he said something similar, which is that folks usually rush to buy gold as prices rise. They get excited as the gains pile up, though often they're jumping in at the worst possible time, and retail buying tells you that the boom is nearing its end. Well, there's no real boom in buying pressure in gold, but there was back in 2011. And not paying attention to, let's call it the money flow. We use that as an important part of evaluation. Money flows into assets that are desirable, and when money's flowing there, that's demand. Demand raises prices. Here in gold, if you failed to sell your gold back here in 2011, the summer of 2011, it was 13 years before the prices reached a higher level. And that's happened earlier this year. And here's where we are now with a little bit of breathing in the price movement. And this indication is that there's weakening interest, at least momentarily. Retail buyers have basically forgotten gold entirely. It's showing no interest at all, despite gold at all-time highs this year. Investors just aren't interested. They aren't buying. Eventually, they will come back to this. They'll pour money into the metal, chasing a dream of easy profits. It's the same reaction that we saw with the tech bubble back in the late 90s, that we saw in the real estate bubble in flipping properties in 06, 05, 6, 7. That collapsed in 08. We look at several other charts besides the one I'm sharing with you. One of those happens to be an AI software that I subscribe to. This is the futures market for gold. And what this tells us is that the actual strength of gold as an asset is very weak at the present time, that the bets on the futures market are increasingly negative, that the momentum to lift the price is falling. And when we look at assets that behave similar to gold, that most of them are in a downtrend. This red line tells us that we're very likely to be in a downtrend through the month, through the middle of the month, and we could see some recovery, but it's going to take a lot of money to push us higher than the recent high. We do not have exposure to gold in our current portfolios. We have had gold in our portfolios this year, but it is not there now. The difference is when this shows green that you're a happy camper. When it's red, you have to have a real understanding of why you're committed to this if it continues to fall, and how far you'll let it go down before you bail out. One of the problems is, how do you forecast stuff? How do you know what's going to go on in the future? And as we've said repeatedly on these webinars, we do not forecast. We look at what's going on today. That we know. The future, no one knows. And that's evidence when we look at stock market forecasts. Here on this particular report, which was put together by Advantis Investors, is they've aggregated the year-end 2024 price targets for the S&P 500 from 20 different firms. These forecasts were issued in late 23, and there are several striking takeaways. First, there's a wide range of views. The highest estimate here projected a rise of more than 13%. What we see here is an S&P close estimated to be close at the end of the year to be 5,400. The lowest estimate at 4,200. Here's our lowest estimate, which is actually projecting a loss for 2024. Aren't you glad? Well, I hope you aren't a client of the firm that estimated that, because your asset allocation model was seriously wrong. We're now, well, actually, as we look at this, here's 20 estimates from December of last year, and the end of December, this is where the S&P was, and it's now even higher. When we turn around and look at this, the implied return based on the consensus S&P 500 year-end price targets for 2024. That's what this is based on. And we're looking at the mean, or the mean returns, the averages here. And what we see is the blue were the average of the forecast, and the orange was what actually happened. The implied return from the consensus estimate was never even within 10% of the actual return. It ranged from an underestimate of 26% to an overestimate of 21%. That is a real problem for any of you who are still working with an advisor or doing it yourself on a website using modern portfolio theory asset allocation models. Because these models are intended to work because you accurately forecast the return for each asset class. Now, I remember being introduced to this a long time ago with a couple of the guys from a big firm, big national firm and money manager, KK&R. At that time, they weren't so big, but they were well known, and they came to the Seattle Financial Planning Conference, the year-end conference, getting ready for next year. And the question was, how do you forecast the returns for each of these asset classes so we know how to build our model? And the head honcho said, well, the last week of December, after Christmas, we all get together in the conference room. We get our coffee or Coke or cola, and we put our feet up on the desk, and we put a slide up on the screen, and we say, well, what do you think the S&P will do next year? And we basically take our votes and we make a consensus. What do you think Europe's going to do? What do you think bonds are going to do? What do you think precious metals are going to do? In the end, it was, well, we guess at it. In early 2000s, I took the accredited investor fiduciary training, and I took the auditor training. And that was one of the real questions, because the entire premise of fiduciary responsibility is to use modern portfolio theory for asset allocation. And the question that I continued to ask, which was never answered, is how do you forecast these returns? The only way to make the model work is to use long-term rates of return and pray you come in somewhere close to average. But even the smart guys on Wall Street, as I just showed you in the last slide, have no clue what's going to happen. They are just simply guessing, which is why we don't do that. But we use what is going on in the market today. And we've shown you this type of data before. This is a segment of what I publish every twice a month in our 401k corporate client updates and for distribution to the employees. All we've done here is said, how are these assets working? Small caps, the Dow, the S&P 500, the Qs, NASDAQ, dollar, which we don't invest in, 20-year treasury, broad bond treasury, general commodities, again, which we don't invest in, and then our cash bogey. We want to invest in assets that are doing better than cash. Why would you intentionally allocate your portfolio to an asset that is not beating the bank? I didn't turn on anybody's microphone. I mean, I didn't really expect to hear an answer, but I'm sure a few of you have to say, yeah, why are we doing that? At the current time, international, emerging markets, and gold are all underperforming cash. This is based on the last 21 trading days in the market. So what we do have here, our bonds are currently better than cash, but less than the S&P on a short-term 21-day basis. So let's take a look at bonds. This is U.S. Treasury bonds, so this is a blend of maturities. And what we see here with the AI software, the artificial intelligence software forecasting, is we did have a turning point here where, at least over the last 3 months, the downward trend that has continued for 3.5, almost 4 years, it looks like it could be turning, and over the last week and a half or so has improved significantly. Down below, we see that the bets in the futures market are still predominantly for better bond prices. The core strength, the momentum, the impression of the application of the money that's flowing into bonds is strong, and the momentum is improving. It's finally reached a level 2, and that's a positive for momentum. And the monthly correlation, the number of assets similar to bonds that behave in a similar manner reflecting investor money flow, is actually quite high. So if you have bonds right now in your portfolio, there's some hope that there's a little bit better promise going ahead into next year, as long as inflation does not resurrect itself. If inflation starts rising again, the Fed will not be able to cut rates. And that's important to remember, that the value of your bonds is tied directly to interest rates. If interest rates are rising, and that happens when inflation is there, then the value of the bonds falls. That's a problem. We still don't own bonds because, as I showed you on the S&P chart, you're still better off being in the market than you are owning bonds if you have a choice. Now, Janus is a major money manager. They own a lot of mutual funds, and they also produce exchange-traded funds. We don't own mutual funds anymore, but over time, we have periodically owned some Janus exchange-traded funds. Janus did this research, and they published this. Actually captured it, I guess, off of Bloomberg. But what's important is, with regard to bond exposure, is what's going to happen to interest rates. And Janus noted that the global economy is somewhat late in the cycle, warranting caution. This is the Fed interest rate here, and the assumption is the Fed will continue to lower interest rates. This is the estimated change for earnings per share. And as we move into next year, that forecast is that earnings will improve and interest rates will fall. Well, that sounds like a Goldilocks scenario. Yet the data continues to defy expectations. Growth is steady. So basically, what does this mean for investors? At the highest level of combination of rate cuts, accommodative policy, stimulus in China, that should lend support to the global economy. Still, There are forces at play that make it imperative to apply caution when adding risk to the portfolio. Broadly speaking, markets have been very quick to price in the extension of the current trend, leaving valuations vulnerable to downgrades. I don't have it in today's presentation. I think I covered it last month, is that the forecast for S&P 500 is always high at the beginning of the year, and every quarter as we move through the year, the forecast for how profitable companies will be continues to get cut. If that happens, then it means that there is downside risk that current investors are mostly ignoring. That we're vulnerable to valuation downgrades. So the economy is strong, relatively speaking, and stronger than the assumption if we go back to September as we started this quarter. And Powell said so himself. He also said that the 4 to 6 rate cuts that they expected last quarter aren't needed anymore. So we're likely to get December's so we don't cause turmoil. But we're not likely to get very many rate cuts in 25. That increases the downside risk for bonds. It's not good news for bond investors. So if you're in bonds, you want to be careful what your maturities are and how much exposure you actually have. So how do we deal with this? Now we run 3 individual portfolios, 3 separate portfolios for individual clients who contract with us, and we run 5 models for 401k employees for the corporate plans that we oversee as fiduciaries, where we select the investments, we do the ERISA maintenance to see that expenses aren't out of whack, that managers doing their job, and that the funds that are in the portfolio are competitive. And we review that twice a month. We do a comprehensive one in January of every year, but this is where we were on November 29th. And as I mentioned a moment ago, we want to own things that are above cash. And here's our cash bogey. First Trust Enhanced Short-Term Maturity Fund pays out right now. It's paying out a little over 4% on a monthly basis, annualized, and so it's pro rata. But on the last day of the month or the first of the month, they will distribute the interest for the month. Not a lot of risk here because the average maturity of these fixed income is about 30 days. So how do we run the model? Well, I'm going to walk you through what we do with the 401k models because it's absolute. The other models we're running for those of you who are clients are run in a similar manner. It's just that the list of assets is slightly different in those models. So the relative strength model invests in the top 10 assets, regardless of what they are. There's no mandate that we own bonds or international. If they're in the top 10, we will own them in those models. And what we see here is large cap, large cap, large cap, large cap, large cap, relatively cheap, mostly large cap, mid cap, small mid, and small cap stocks. There's no international, there's no bonds, because this is where collectively investors are putting their money. Remember Who Wants to Be a Millionaire? And if you were stumped by the question, you had 3 choices, and it turned out when the series was all done, the most accurate choice, if you were stumped, was to ask the audience. The collective knowledge of the audience was the best source of information. That's what this is. The stock market tells you the collective consensus of investors around the world where you should be putting money. And that's what this model does. It says, at this point in time, these are the 10 best places to do it. We're going to diversify. There's obviously some overlap. What we're not buying at anything below cash are international, and gold. There are two international funds that are above gold, and bonds are above cash. I said above gold, I meant above cash. There's some more bonds. There's bonds. The other area that I want to point out just briefly is we have target date funds in here. What I showed you a couple of minutes ago is why not to be in target date funds. Well, it's not that we're absolutely opposed to target date funds. 401k trustees have a legal mandate to provide diversified assets. And federal regulations have said and determined through some court action that if you provide these target date funds as a trustee, you will not be sued for having failed your fiduciary duty. So every 401k plan probably has target date funds as an option. If they don't, it's a real outlier, and the trustees don't know what they're doing. Why do we have them? Well, to meet trustee obligation. The issue is that if these show up in the top 10, we use them. If they are providing return, they make sense. If they're not providing leadership, they don't make any sense. At least that's the way we look at them. And with the ones we use, the plans that we now work with all had target date funds from elsewhere, and Fidelity was some of it, and others were elsewhere. And I pointed out that the Fidelity Fund at target date 2050 had an expense ratio of 0.75. We switched all these to Schwab's because the expense ratio is 0.08. So this is almost free compared to what Fidelity charges. And we have found that these particular funds actually make sense with the way they allocate money and the way their returns are generated from a month-to-month basis on risk adjustment. So if you have a target date fund and it swings between really working well and not doing so good, they're not managing money. They are just collecting fees. It's a set it and forget it. Popillo, I think was his name, with his magic cooking tools. Anyway, so last month, if you were with us, this was our asset allocation at the time. And here's where we are today. So the select model, looking at that list of funds that we use, which are Schwab's ETFs, I think there's about 35 of them now. We own 20% of the top 5, as long as it stays a leader. And it can drop below the top 5, but as long as it's still doing well and there's not a reason to sell it, it stays in the portfolio. And this recent check this last week, there was no reason to change anything. So this is basically the same as a month ago. Global has a larger universe of funds that we use, and those change more often because they're focused on sectors and asset classes. And Dynamic has an even larger list of sectors and industries, so it changes more often. And the chart that I just showed you for last month is we had a large exposure to gold, and I think we had some silver in there. Well, we had some commodities exposure, which was also included energy. We do not have any of that at the present time. So as I have pointed out, and Perry's pointed out, we're not in the prediction business. We just simply do not what is going on in the future. We're in the interpretation business. We need to know what's happening now. Investors, well, frankly, investors are fickle. I want to make money. That's not a surprise. I should be in something that's working. That's not a surprise. It's a little more difficult than just setting it and forgetting it. It requires paying attention to what's going on because markets are dynamic. They are constantly changing. In order to preserve your account, you can't go to sleep and pretend nothing is going to change. I had a call from a lady in Idaho, and she said, I used to work for a company where you were on their 401k account, and I liked what you said. And in my company, they don't tell me anything. And when I ask, they say, well, you got to figure it out on your own. Can you help me? And so as it turned out, we happened to have the list of her assets that were available with her employer, and it set her up on our automatic update as a 401k participant, so that twice a month she knows where she should be invested, how to allocate the assets that she has. Somebody's paying attention. If you don't do it, who is? We can. If you want to hire us, we'll be glad to talk to you about it. But someone else needs to worry about it, pay attention to it, and when it's time to make a decision, to actually make the decision and place the trades to reallocate your account. Or you can pretend that averages will work if you just live long enough. And that assumption means you've got another 80 years ahead of you.